Welcome. We've learned there was a robust conversation among RBA board members. Do you believe the views of Michele Bullock, Andrew Hauser and other RBA officials carried the day?
Well, thanks, Kirsten. I think it's reasonable to expect that the two internal members were with the majority. I think it's clear that the two internal members have been very focused on the inflation risks and seeing the inflation that we have as being a domestic issue relating to weak supply capacity. And I think the way to think about the split decision was in some ways the reverse of what happened in July last year, where a minority voted to cut rates because you weren't going to learn anything between the July and the August meetings that would dissuade you from cutting rates, and you may as well get on with it. And a lot of market economists took that view as well. But in the end, the majority of the board opted to wait and see. And so this time around, a minority of the board members opted to wait and see because there is a lot of uncertainty, and at least some of the new information around inflation risks, which relates to the conflict in the Middle East, could well unwind in the near future, depending on how that conflict unfolds.
In your view, is the May hike due just ahead of the federal budget more or less likely now?
It's probably a little less likely, but it is still our expectation. A couple of months ago, even, the Reserve Bank was clearly worried about domestic inflation pressures. It still regards Australia as only being able to grow around 2%. And that means they are going to be very focused on domestic inflation risks. The conflict in the Middle East and what that means for energy prices is another blow on top of that in terms of near-term inflation. And so while it's not a certainty that they will hike in May, it is what we expect.
What are the consequences for the Treasurer's framing of that May budget? Does he need to change his approach to the changing economic challenges?
I'm not going to tell the Treasurer what he should put in the forthcoming budget, but I think it's reasonable to expect that any government in these circumstances will be seeking ways to ensure energy security and to put the budget on an even better footing. Remember, Australia is actually in a much better fiscal position than many peer economies, and they will be facing a corporate tax windfall because of high commodity prices, so their revenues will be higher as a consequence of what's happened recently. So that's both an opportunity but also an impetus to make sure that the budget is on a sound footing.
So monetary and fiscal policy could work better together to bring inflation down and avoid an economic downturn?
There are things within the government's power, and I mean all layers of government, to help reduce the inflationary pressures in the economy. And among those are the prices that are within their control, the fees they charge, the prices that they allow regulated entities to charge. Those so-called administered prices have actually been increasing much faster than the RBA's 2.5% target midpoint. Council rates are up more than 6%, postal charges up more than 5%, water bills in Sydney went up 13% in October. You know, these are all making it harder to keep inflation low. They're not the main reason for high inflation in Australia, but all of those things are not helping.
Is it your view that the economy will need to see some kind of downturn for inflation to be under control?
We'd like to think that Australia can keep growing and get inflation back in the 2 to 3% target range, just as we did last year. We think Australia can grow faster than the 2 to 2.1% that the RBA seems to think is feasible, but there will be some levers that need to be pulled. That may mean higher interest rates for a period. It may also mean other regulatory responses from other parts of the public sector.
Luci Ellis, thank you.
Always a pleasure, Kirsten.